is Jamie Keach. This is Nick Nafrio. We write a newsletter called the Resource Insider Newsletter, where we look for opportunities in the mining, energy, and infrastructure sectors to invest our own money. I'm a mining engineer by training. We started off really focused on gold and copper stocks, primarily publicly traded. But over the years, we have shifted our investment focus. And today we're going to talk about some of the factors that have led to that and what we have done about that.
We're going to talk a little bit about how we view markets right now. We think that we are entering a new investment environment. For the last 35 years, we've been in a falling rate environment. And we believe we're entering into a secular bear market for bonds, meaning that we think rates are going to be rising for the next several years. And we're going to be talking about why we believe that today. So one of the main drivers behind that is the U.S. deficit. So since 1800, 51 out of the 52 nations to reach 130% debt to GDP ratio, like the U.S. has recently, has defaulted on their bonds. And basically what that means is you have to inflate your debt away. So you have to devalue your currency at some point. And we believe this is a driver for rising yields, because as you deflate your currency, basically what's happening is people are saying, we don't trust your government anymore. And why is that happening? Majorly because the U.S. is in a twin deficit. Basically, we have a fiscal deficit, meaning we are spending more than we make in tax revenue. The second portion of that is a current account deficit, meaning we are an importer more than we produce. So basically, the U.S. is a consumer-based economy. We no longer produce goods in the United States. And this affects our economy, our dollar, and our interest rate environment that we're in. And we believe that we're going to be stuck in this environment for quite some time, because when you look at our spending habits, there are three main points where we spend all of our money, and that is interest expense. And as yields rise, interest expense keeps growing. Number two is military spending. And as we keep seeing international conflicts grow, there's not going to be a world where we believe that we can cut military spending. And then lastly, it's the social programs. That's Social Security, Medicare, Medicaid. No matter what side of the aisle you're on in U.S. politics, you're not voting to cut those programs. So even though there's been a big push with DOGE, the Department of Government Efficiency, there are some very sticky spending items that cannot be cut, which make up most of our deficit. So when we think about that, we have to have inflation to right-size our debt, right? And so when we look at the current environment, in the black line you'll see this is where inflation has been for the last 20 years. When you look at the last 5 years, really we see us finally breaking out into kind of an inflationary environment. And inflation tends to come in waves. And so right now we're kind of at a trough. Usually when you see these waves come, they happen in very short time frames. So when we had the inflationary period in the midst of COVID, you'll notice that the spike really happened over several months. And then since then, we've been in a disinflationary period where inflation is still high, but it's been slowly coming down. And we believe we're on the cusp of entering the next inflationary period. And when we compared that to the last hugely inflationary period, which was the 70s, there is very eerie correlation, both on magnitude and timing. And we believe we're just gearing up for the next wave over the next year or so here. So we want to talk about how this impacts investments. And the example we're going to use is buying a house. You guys save up $75,000 and you want to buy a rental property. So how does an interest rate environment affect these asset prices? So if you spend $375,000 buying a rental property, put a $75,000 down payment down, and you have a $300,000 loan, at 4.5%, you're basically paying $1,500 a month in a mortgage. Now, if you can rent out that property at $2,000 a month, you're pocketing $500 a month. So what happens in a falling rate environment, right? You own this property for 2 years, interest rates are down to 2.5% now, and you're looking to sell your property. So the next investor comes along. We're assuming, for the sake of this exercise today, just to show how asset prices are affected, we assume that your monthly rental rate stays the same. So it stays at $2,000, and investors are expecting to make that same $500 a month above the mortgage rate. So how much can you pay per month and make that same income? Well, at 2.5%, you're able to pay $480,000 for that same rental property. That's a $105,000 profit on top of your $75,000 investment. So this is the environment we've been in for the last 40 years. And what tends to happen is you see somebody sell their rental property. Now you have $180,000 instead of $75,000. You roll that forward into another rental property and you keep growing. But what happens in a rising rate environment where interest rates are expanding, right? Now, for you to be able to afford that $1,500 a month in a mortgage payment, you can only afford to pay $300,000 for that same rental property. So if you were to sell that property, if you were forced to, after a few years, you would lose your entire down payment. That's 100% loss, just because rates are rising. So the question is, what do you do? So the first option is you do nothing, right? You own this property, your rent is covering the mortgage, you don't have any out-of-pocket expenses, you're actually making a little money, so you say, you know what, I'm gonna own this until I pay down the debt. Option 2 is you figure out how to increase cash flow on this asset. You add value, right? So maybe you build an apartment above your garage. You add an extra $1,000 a month in rent, and now your total rent increases to $3,000 a month, and you get a repricing of that asset.
You know, I think the main takeaway here is from us and how it's influenced us is for the last, number of decades, you've been rewarded for owning assets and doing nothing. And now we think we're in a period where you have to own an asset and then increase the value of that asset and improve the business on top of that asset. And, there's everyone in junior mining is waiting for the next boom, the next super cycle, the next China to come in and create the demand so that there's a supply shortage and every equity skyrockets. But that all happened in a deflationary environment. And now we're not in that anymore. And we think that the way stocks and businesses will react are going to be different, and it's going to favor different businesses. And we're going to get into what that means and what we're doing about that.
So in an inflationary environment, we look at what asset classes outperform. And largely, it is energy and copper. And that's by a pretty wide margin. You'll see energy and copper there on the bottom, and then the CPI rate on the very top, and right below it, you'll see the S&P 500. So when we're looking at this chart, that's about a 20% outperformance of energy and copper over the S&P per 1% annual rise in inflation. And we were talking about how this environment is begging the question of where you should invest, but also how. And we talked about how you have to be more selective with assets now, figuring out what assets are going to have value add to them, where you could improve an asset versus just owning it and making money by holding it.
What do all these people have in common on this list? They're all over the age of 64. So these are some of the biggest entrepreneurs, CEOs, investors in mining and energy. They're all the billionaires who've built the deca-billion-dollar companies. Some of them have unfortunately passed away already, and most of them are in their late 60s or 70s. And there's a huge generational gap in this industry. You know, there's people like Nick and I who are in our 30s. There's a handful of people in their 40s and 50s, but all this success is still in the hands of people that are near retirement or already there. And we've been thinking about this a lot in terms of where we want to invest our money and how we want to do it. And some of the problems we see in commodities is this brain drain that's happened over the last 40 years, that there's been a huge gap in opportunity to make money. So the guys that were doing this 40 years ago were very successful. The people that have been doing this the last 20 years haven't had that opportunity of success, and they've gone and worked in tech or real estate or what have you. So there's a missing generation of leaders and technical experts in this space. And so I think there's going to be fewer and fewer good opportunities to invest in, but that there's going to be so much wealth that accrues to those opportunities that can execute well. So that's the problem. It's also the opportunity. Obviously, as you all know, there's been a historic lack of financial and investment discipline in this. There's been a lot of capital destroyed. And so the result of that is these assets tend to trade at lower valuations than other assets in other sectors, such as real estate. And the result of that has been there's little or no interest of investors. You know, this conference, one of the best mining conferences in the world, it's relatively small attendance in compared to other sectors as well. And so it's been a very challenging environment, and we think it kind of offers a unique opportunity for the people that have stuck it out over the last 15 years and do have capital to deploy. And so at Resource Insider, we really have one goal. We invest in, acquire, and build high-quality commodity businesses led by capable teams. We focus on quality assets trading for less than their replacement cost. Right now, you can invest in almost any mining company, but a few great ones, for a fraction of what it took to build them. We look for cash-flowing assets with very low-cost operators. We want to see our operators be in the bottom quartile of cost, which means in the case of mining, it costs less to get an ounce of gold out of the ground than most of your competitors. We're looking for a significant upside in expansion. We're going to talk on that in a minute. And we're looking for a meaningful barrier to competition and buying assets, or we're investing in assets in commodities that are at their cyclical bottom. That means, we invested heavily in uranium at $25 a pound, not $100 a pound, for example. So we have bought 5 stocks this year in our portfolio in the newsletter. This is the performance of each of those stocks. 4 are up and 1 is down. We bought Silverco Mining because Silverco Mining had something like $130 million spent on a silver mine in Mexico, and we were able to invest at a $10 million valuation. We thought that was a pretty good deal. It's turned out to be so far. GSP Resources, small BC, copper, and now gold, silver. Explorco with a historic asset. Very similarly, there had been something like $50 million invested. We invested at a $3 million valuation. Comstock Resources, this is where we talk about the cyclical bottom of commodities. So Comstock is a natural gas exploration and development company focused in Texas. We saw this as as a business that was heavily levered to gas price. Last summer, gas was trading at $1.92 an MCF, which is a historic low and so cheap that should probably never be a well drilled in the United States again. And we figure that's probably a good time to start buying gas. And we were right. Solaris Resources, phenomenal world-class asset in Ecuador, run by a gentleman named Richard Wark, one of the most successful mining entrepreneurs in history. They were blocked by the Canadian government from taking Chinese investment, which absolutely devastated the share price. And then I think wisely the company decided to re-domicile to Switzerland and bring in the ex-head of Glencore Copper as the CEO. So we took this trade on access to investment that they wouldn't have otherwise had. That's a few months old and it started to work out well. Mayfair Gold, our only asset that has gone down this year, our only company rather that's gone down this year, phenomenal asset, but a hostile takeover took over the business and kicked out the team and has been in the process of replacing them. So they've traded down a little bit on that. We bought in on that news thinking that this was going to give this company a fresh start. We still hold it, and we intend to hold it. We think it will do well. And we only have 2 minutes left. We're always slower than we think we're going to be. But what we've really focused on at Resource Insider over the last 2 years is building businesses that meet this criteria. So we've built 3 businesses over a 4-year period, all of them cash flowing businesses focused on energy, mining, and carbon credits. Cicada Logistics is a frac sand terminal business in North Dakota. We bought a frac sand terminal. We've expanded the revenue lines there, brought in new business. It's a cash flowing business. It's a private business, and it's a dividend-generating business that will dividend out cash to investors year after year as we continue to build that business. It's simple, it's easy, it's almost idiot-proof. That's why we bought it. And we bought it for less than a 6x multiple for a $40 million infrastructure asset that would cost something on the order of $150 million to build today. So we bought it for way, way less than you could build it today. And we bought it as frac sand is at a cyclical low. So it's a bet on frac sand, it's a bet on infrastructure. Second, we've done Roger, which is the Resource Insider Oil and Gas Royalty Fund, where we have worked with a team of landmen. Has anyone seen the show Landmen? Yeah? No? It's a new show with Billy Bob Thornton. So we invested with a team of landmen in Oklahoma to secure royalties on Oklahoman and Texas oil and gas, primarily gas assets. It's not nearly as exciting as the show Landman, but it has turned out to be more profitable than that. So that's gone well for us there. And then finally, and first, we did a company called VRIC Carbon. And this is a great example of why this strategy is done so well. Because in VRIC Carbon, we invested in carbon offset projects. And I don't know if you know anything about carbon credits, but they've absolutely gone to over the last 4 years. But Vita is still a cash flowing, profitable business because we structured our investments to be at very, very low prices. We've kept a very, very low overhead, and we've worked with world-class teams. So it's put us in a position that we can comfortably weather the volatility of very volatile markets. Nick, anything you want to add in our last 57 seconds?
We talked about how there's this huge age gap in expertise, and these are examples of where that is coming in as a huge opportunity for investors today who are able to find good assets because you can pay such a low price for them that you're experiencing very high yield.
And the last thing is all of these investments were funded solely by ourselves and the readers of our newsletter. We've invested between $10 and $25 million in each of these businesses. All, normal, hardworking people writing anywhere between $5,000 to $1 million investments with us alongside us on the same terms. So that's it. Thanks for listening to us today, guys.